There's a smart new website that will change the way you invest using social media.
LikeFolio.
Here to explain,
A team of brothers, Andy and Landon Swan.
of LikeFolio.
And they've always been building out great technology at the intersection of social and trading.
Powered by unique social data. Analyzed by legendary traders. The LikeFolio broadcast starts right now.
We're going to get into the weeds today a little bit. We're going to get educated, so you better strap your brain on.
That's right.
Turn it on and start listening. I was talking to Nick the other day, and he referred to something. He said something like, well, the VIX is so low right now that I'm really not really deploying that much of my capital. And it just kind of triggered to me, wow, what are you talking about? Because I've been trading for 17 years and I've never considered utilizing market volatility measures to change the way I approach how much capital I'm allocating. Mm-hmm. And I thought, well, I want to learn this. So don't tell me now. Tell me on the podcast so everybody can learn with me. So Nick is here, Landon's here, and we're ready to learn about this stuff. So Nick, let's dive right into it, because I think this is a important topic. It might take us a little while to get through, but could be kind of cool.
It's a very interesting topic, and it really the way I deploy capital. First of all, I should say I'm an options trader, so the majority of my trades are associated with options, and the majority of my options trades are naked risk. So you have undefined risk situations going on here. A blend of undefined and defined risk strategies, but the majority of my strategies are undefined risk. What you get when you have undefined risk strategies is buying power effect increases and reductions based on the volatility in the underlying that you're trading. Now, the volatility in the underlying that you're trading can be and is impacted by the broad market volatility, otherwise known as the VIX.
So the VIX is VIX, and that is a numerical measurement of the volatility of the S&P 500. Correct?
Exactly. 100% correct. So the VIX kind of tells you
higher is more volatile.
Higher is more volatile. Higher means basically more fear in the overall market. Lower means less fear, more complacency. Right now we're in a very low fear environment. So we got a VIX at around 14.
So users of Thinkorswim, how would they, I mean, I know how to do this, but just tell them, how do we find the VIX in the Thinkorswim platform?
Great question. Just go to the chart tab and type in VIX.
Just like any other ticker symbol.
Or you can go to the trade tab and type VIX as well.
Okay, cool.
Then another thing you can do is /VX, which is the VIX futures.
Okay.
But I tend to just straight up look at the VIX when I'm basing off these numbers that we're going to talk about.
Okay. So the VIX right now is like 14?
Around 14.
Okay.
So it's in what I consider a very low volatility environment.
Is that out of 100? 14 out of 100?
It's out of infinity.
Infinity. Okay.
But generally, I mean, the highest we've seen in years, the peak of the VIX back in 2008 when we had the subprime mortgage crisis was 90.
Okay.
So I consider, basically I consider you get 17, 18 as like a mid-level. Anything above 18, I consider getting into high territory.
Okay.
Anything above 25, and I'm lights out selling premium, no matter what. Like I'm just selling premium. Because your volatility premium is so high in these individual options because of the VIX levels.
Okay.
So right now we have a 14 VIX. So what I do is I deploy somewhere between 40 and 60% of my capital. So whatever my net liquidity number is, let's say it's $1 million, then I'm going to have 400 to 600,000 of that million deployed in a variety of strategies, variety of option strategies, and maybe some stock positions here and there. And the reason I keep less of that capital deployed is because, like I said, a lot of my option strategies are undefined risk strategies. And if we get that pop in the VIX, the buying power effect of those undefined risk strategies is going to increase. So where the buying power effect may be 10,000 right now, if the VIX pops from 14 to 18, it could be 20,000. my buying power effect
You could get called out
can double.
just based on that. You could have a margin call.
Exactly. So you got to keep that cushion to reduce your margin call risk, essentially.
Yeah, and not just that. I mean, this makes sense to me. Even if I were just trading
It goes
stocks,
beyond that, exactly.
to have less capital deployed when the market is quiet and calm and there's not much fear.
And trickling higher.
And then as the market gets more fearful, generally the VIX goes up as markets go down quickly.
Always.
So generally as the VIX goes higher, that means that there's more volatility in the market, but it also means that there's a greater chance that things are mispriced.
Exactly.
And that's when I want to deploy capital. That's when I want to deploy more capital.
100%.
So even if I'm trading stocks, even if I'm I buy only, then the best time to be buying is when the VIX is at a high level, because those tend to not last. So it shows that assets are mispriced.
VIX 25 plus, I say fire away on the buy side.
Yep.
VIX at these levels, I say fire away on the short side.
So, I mean, is this, you talked earlier that when stocks go down, VIX goes up every time. I assume the opposite is fairly true. When stocks goes up, VIX goes
when
down?
broad-based indices go down, the VIX goes up.
Okay.
So the VIX is based on the S&P 500.
So
there could be some stocks in the S&P 500 that are going up while the VIX is going down and the broad-based market is going down. Just want to make that clear.
So if we connect the dots, according to what you guys just said, aren't you just saying buy low and sell high?
No, not necessarily. I'm saying deploy more capital into premium selling option strategies when the opportunity is better.
Okay.
Which it's better when the VIX is higher because there's more premium baked in. But it does tie into what Andy, it ties into what Andy says.
If he was, yeah.
Because if say I'm selling a bunch of naked puts when the VIX is 14 right now, and there's not much premium baked into these naked puts in the first place, so I'm not able to get that far away from the money when I'm selling these puts. Markets on average go down 3 times faster than they go up. So if we get this sell-off, we're going to have this rapid sell-off in a 2-day period. My naked puts are in a terrible situation. Whereas if I've deployed less capital towards those puts, I wouldn't be in such a terrible situation. Or if I just avoided that strategy in the first place because of the low volatility environment. So there's a mixture of things going on here. You have to pay attention to what type of strategies you use in low VIX environments. You have to pay attention to how much capital you deploy. So to tie it back into what I was just saying, I don't necessarily sell naked puts in low VIX environments, but I do sell them big time in high VIX environments.
Okay.
Yeah, and I don't think it's necessarily fair to say when the VIX is low, that means the market's high, or when the VIX is high, that means the market's low. It just means that that's likely maybe that's where it's been moving recently. Over the last recent bit, and the faster it's moving, even up. I mean, even in 2008 when markets, they went down so fast and they would bounce up the next day like 500 points on the Dow or something like that. Even then you stayed at a high VIX level because there was a lot of volatility and there was a lot of fear that what's the next shoe to drop? What's the next big bank or brokerage to go out of business or whatever. So,
and that goes back to Nick's point about markets going down 3 times as fast.
Yeah.
That's why the VIX goes up when the markets go down, because if they're moving 3 times as fast on the way down, then there's fear, there's volatility.
That creates panic.
Right.
When you get that much selling, it's a domino effect, and that creates a big escalation in the VIX. At the end of the day, for me as an option premium seller, mostly, it really comes down to VIX is an opportunity gauge.
Right.
Low VIX, low opportunity. Medium VIX, medium opportunity. High VIX, tons of opportunity.
For selling
premium.
Okay.
Now,
premium, yeah.
Now I do take into account which premium selling strategies should I be focusing on based on the VIX environment, but that's kind of a different conversation. But I just kind of mentioned that with the naked puts situation. I don't really focus on selling naked puts in a low VIX environment if I'm selling premium. But I will focus on selling naked puts in a high VIX environment or even a medium VIX environment.
Right.
18 is the level of the VIX that I consider kind of the medium level. Anything below 18, I'm deploying somewhere between 40-60% of my capital. Anything right around 18, I'm deploying 50 to 70% of my capital. And anywhere above 18, I'm getting to the 60 to 80% capital deployment. Now you notice I say 60 to 80. There's no time where I say 100 because I never intentionally deploy 100% of my capital. I always keep a little bit of cushion. 100% of my capital may eventually be deployed because of the buying power effect adjustment causes it to be deployed.
Right. And what's crazy is is this statement true that you could deploy 75% in a high VIX environment and the positions could maybe not go against you, but the VIX could go up and cause your buying power to go up, even
Absolutely.
though you haven't lost any money.
100% correct.
That, if I was new to trading and that happened and I'd got a margin call when I was even on the trade, I would be just flabbergasted. So this is a great warning to people.
Absolutely. And if you're at 75% capital and that situation happens, you're probably not going to get into a margin call scenario. But if you have, 95% of your capital deployed, which is why my ceiling is 80%. So
Okay.
I always have that little buffer.
I like it.
Plus, you just never know when another opportunity might pop up.
True that. True that.
So let's get into, this has been really like a great overview of how you decide how much capital might go into the market. But then inside of that are strategies that some work better in a high VIX environment, some work better in a low VIX environment. And there's, it seems like there's also you've alluded to some decision making in terms of, which ones might get more of your attention or capital in different environments. So let's just go through a few of those. And, I don't think we can get into all of them because that's probably another show.
I agree 100%. We should probably just talk about maybe two strategies in each category.
Yeah. Well, let's talk, since right now the VIX is around 14. Let's talk about the strategies that would be great at 14. And then let's talk about one strategy or two that might be great if we see a pullback and the VIX gets to 18 or something like that. Let's start looking into
Sure.
what's now and what's a potential opportunity over the next little bit.
So it's important to start by saying when I'm looking for a low volatility strategy, not only do I notice that the VIX itself is low, but the implied volatility associated with the specific underlying that I'm looking at or stock that I'm looking at trading, the implied volatility for that stock also has to be low, which in general, if the VIX is low, implied volatility on these underlyings are mostly low. But you have to, I always double check.
There's always outliers.
I want both.
So
for example, right now, I think Apple has extremely low implied volatility in the stock itself. I think the IV percentile, which measures where the current volatility is in comparison to the last 52 weeks, I think it's at like 3, which essentially means it's at the bottom end of its 52-week range, implied volatility. So very cheap premium in Apple options. And then we have the VIX at very low levels of 14, well below my 18 middle metric.
Yep.
So that would translate to a good low volatility, debit type strategy where I'm okay with buying premium because I think, there's not a whole lot of risk to the upside. So I might consider buying puts or calls at this extreme low level, which I generally don't do too often, but we're talking about extremely low combination of events here.
Right.
So buying puts and calls should not be out of the equation. If you see a really good directional opportunity.
And just so people understand what you mean when you say buying or selling premium, the premium on an option is the price, the portion of the price of that option that is speculative, that is not intrinsically held within the option. So if you have a $30 call option, the stock's at 32, there's a $2 intrinsic value to that. It's it's absolutely worth $2 no matter what. And then you have the premium, which is associated with how much time is left in it, how much volatility the market, thinks is going on. That could bring that price up to $3.50 for that option. So now the intrinsic price is $2, the extrinsic or premium is $1.50.
Exactly.
So
and the option itself is $33.50 in your example. Right. You said it was 30 strike.
Yeah.
And just making sure people know where the $1.50 goes in. It's part of the price.
What's that? I have no idea what you're talking about. 33.50.
You mean the price of the underlying?
I'm sorry. 350 is the option itself.
Yeah.
Yeah.
Okay.
The option is $3.50.
Intrinsic value is too.
I was thinking break even. Sorry. Ignore me.
Your break even, if you buy you're right. You said it wrong at the wrong time, but you are correct.
Break even. I'm with you now.
Your break even is $33.50
on the calls. If you bought the calls,
if you buy the calls,
we got to do this on video because Andy's face there was like, WTF, Landon.
I was looking for like one of those buttons that the guys at the Oscars use when somebody cusses on stage. I was just like, silence him.
I meant to say break even. That's a critical word to leave out.
Yeah. So your break even is $33.50 because you bought a call option that has a strike price of $30 for $3.50. So you need this at the expiration. You need that option to be $3.50 above the strike price
in order to break even.
So that's your break even price. So it needs to move $1.50 for you. That's what the premium is you're paying for that option over time.
And if you get a nice upside move quickly, then you won't have much of that time premium decayed out of there.
Right.
The value of the option will increase and outpace, and it could be worth $4 or $5. If you get a uptick in implied volatility, which is huge in this case, it's very probable that the implied volatility of something like Apple is going to increase because of the fact it's at the low end of its range, and it shows, in the past when it gets this low, it tends to pop.
Yeah.
If you get that pop, within a few days of buying the calls, the intrinsic value or extrinsic value you're talking about on the volatility premium increases. So the value of that option increases.
That's cool. Because Apple, the stock could be, in Andy's example, the stock could be at 32 when you got in the option at $3.50. The stock could go down to 28 and back to 32 in a couple of days. It hasn't moved since you got in it, but your option is worth more because now everybody's like, whoa, this thing is volatile. Mm-hmm. And that extrinsic value is going up.
Or I've seen where the price of the stock doesn't move at all, and for some reason the implied volatility ticks up.
A rumor comes out that they're going to
put
a car out.
Some sort of news event,
right?
Is coming
That's
up
true.
that wasn't priced in for some reason.
Yeah, it's not even price related. It's just anticipation.
It's just exactly. It's just event related, binary event related. Excuse me.
Cool. So we're at low VIX, and if we look for low implied volatility on a specific stock, which we can see inside of Thinkorswim as well, right there on the options chain.
Go to the charts tab. Well, the way that I like to look at it visually.
Okay.
So I'll look at a VIX chart separately, and then I'll go to a chart like Apple, for example, AAPL. And if you you're on the charts tab in Thinkorswim, you go up to studies, add study, volatility studies, and IMP volatility. And what that will do is it will put a subgraph under your price chart. Mm-hmm. It'll put a little mini chart under the price chart that tracks, the implied volatility of that stock for whatever period you have on the chart. So if you're looking at a 1 year chart, it's going to show you the 1 year, volatility trend.
Nice. And right now it would be very low.
It would be at the low end of its 52-week range.
All right. So we have that combination of events happening, and now it's open season to say, hey, I normally don't buy premium, but right now I'm kind of comfortable buying puts and calls because any little market event or Apple event or anything like that could give me an expansion of that premium. And
another strategy I want to touch on really quick is a calendar spread because it's another debit strategy. Essentially, you're buying a further out of the money call or put and selling a closer to the money call or put. So you're financing a portion of that longer term put by selling the shorter term put. Mm-hmm. And if the volatility ticks up, it doesn't really impact your trade that much because the volatility will be priced in on the short term one that you sold. Right. You'll have a small loss on that part of the position, but the volatility that expands on the long part offsets that. So
generally speaking,
yeah. And in a lot of cases, the longer term one, the volatility expansion will be greater than the volatility expansion on the short term one.
Gotcha.
Because there's more time, so there's more uncertainty in that longer period of time.
Sure. That's interesting.
Cool.
So that's a good way to kind of throw a little bit of premium selling in with the premium buying, but you're still a net debit. You're still a net buyer.
When you do that, let's say I sell this month and I buy 5 months out. Is that reasonable that's that much of a difference? If I did that and this month went worthless and I
You roll to the next month.
I just sell the next one and just keep
if you want
going?
to.
Okay.
Same strike.
Cool. Oh, it's always the same strike.
Always the same strike. So if we're using that 30 example, you'd buy the 30 that expires in July, say, and then, sell the 30 that expires in July, buy the 30 that expires in September or something like that.
Very cool.
Very cool. Very helpful. Well, hopefully we'll get VIX. I know everyone that trades options, generally speaking, everyone that trades options likes VIX numbers that aren't at 12, 13, 14.
Mm-hmm.
That, it's almost like, all right, the VIX is at 12. I'm going to go golfing kind of thing.
Yeah, I feel like I need to go back to the beach.
Yeah, exactly. So hopefully we get a market environment, which it seems likely to me with an election year and with, great, England talking about getting out of the euro and all that kind of stuff going on, especially election year. I just feel like, as we get past Labor Day, we might see, volatility increase in the market, and we might have the opportunity to do another show where we say, all right, now we got some volatility. Let's get in some strategies, for this type of environment. So
I agree.
But for today, the big takeaways, when market volatility is low, it's kind of the opposite of what you think. When market volatility is low, you want to keep your capital deployment lower. And as market volatility increases, you want to take advantage of that and put more money to work. And,
that's definitely the opposite of what I would have thought.
Yeah.
And again, I want to reiterate, it applies primarily to my style of trading, premium selling.
Right.
But it can also flow into, just plain old stock buying and shorting, or, premium buying. But it applies primarily to my style.
Yeah, but I think it also, just thinking about it from just purely a portfolio perspective, there's a false sense of security when deploying capital into a portfolio when the VIX is at 14. You think you know a lot more about the potential range of this investment that you're getting into than you really do.
That's a good point.
Because you're at a historically low volatility period, and anything I think about in life, if things are pretty calm, that's kind of the worst time to get really heavily involved in that thing.
Right. Like if life in general, super calm, everything's steady, and then I'm going to go buy a really expensive house, over leverage, get
Exactly.
like 5% down. And then all of a sudden things start happening. You're like, whoa, volatility's going up. I like that. But if things are going crazy, then you can kind of gauge what kind of house you should buy.
Yeah.
I always know when I'm going to get, when I'm going to get like a bad cold or something, because I'm like, man, I've been feeling really good for like months now. This is like amazing. As soon as I start to think about it,
right.
Like as soon as you become aware of the fact that you've been super healthy and like feeling great for several months, it's like 2 days later, you're sick.
Yeah. Honey, I know I promised you a new car, but we really need to wait till the VIX is over 20. I just listened to the LikeFolio podcast. The only thing,
guys, you now have an excuse. Your wife wants to go shopping. You're like, honey, the
show her a VIX chart.
We're at VIX
as soon
14.
as the VIX gets to 25, you can go shopping.
That's awesome.
All right, great show. This is great. Hit us up. Make sure you subscribe.
I feel like we should. I want to congratulate you guys for second place overall, LikeFolio at the Benzinga FinTech Awards.
Oh yeah,
that was something.
Congratulations to all of us.
Overall.
Yeah, that was 50 companies or something like that. It was,
there was 200 or 300 that applied. Yeah, that were involved from the very beginning. So big honor, great, tremendous event that Benzinga put on.
It was so good.
A lot
of
of fun.
Good last year, and they upped it a lot this year. They brought it.
Put it on your calendar for late next spring. I don't know where exactly you put it, but sometime in April or May, there's going to be Benzinga FinTech Part 3, and you don't want to miss it because
there might be some good bourbon involved.
Yeah,
that's why you don't want to miss it.
we put the Pappy away, and
Pappy 20, man.
It was a phenomenal night. Great night for LikeFolio, a really good night for Benzinga, and just a good night overall for the fintech community, which I think is well deserved because there's a lot of cool things going on.
It was very cool. I learned a lot there. There's some really cool companies.
Yeah. Subscribe in your podcast app so you don't miss an episode. You got questions or comments, hit us up. We're on Twitter at LikeFolio. We're on Facebook. Just, search for LikeFolio. And also make sure App Store, the LikeFolio app is cool. It's got the podcasts in there and it's got all of our commentary. So make sure you're on that. And until next time, have a great time.